Hello, my name is Nathan Siebert, and I'm a Senior Account Manager for the Federal Long-Term Care Insurance Program. I want to tell you a little bit about myself. I am a certified long-term care consultant, long-term care professional, certified senior advisor, but I think it's also important to note what I'm not, and that is I'm not a salesperson. So we are not here to sell you any long-term care policies today. It's really more about educating about long-term care needs and where long-term care insurance might fit into your retirement planning. In fact, what I try to do is break this presentation down into two parts. And the first part is just, what is long-term care? I want to make sure we're all on the same page about the type of care we're talking about, what's going to pay for long-term care, probably more importantly, what's not going to pay for long-term care. Then once we can all agree we're talking about the same type and style of care, that's when we'll transition into discussing long-term care insurance, specifically the Federal Long-Term Care Insurance Program, or FLTCIP, how it's different than private market plans, how it's the same, how you build and design your plan, and then, of course, what your next steps are. So first thing is, what's long-term care? So we are headquartered in Portsmouth, New Hampshire. I live just over the border in Maine. But normally what I do is I travel all over the country to discuss long-term care needs and long-term care planning. And people back home are always asking me, well, what is it exactly that you do when you're out there? I say, well, I educate about long-term care needs. And they look at me a little bit funny because they've heard the terminology, but they're just not exactly sure what it is. I say, let me make it even easier for you. The type of care that we educate about is if someone needs help with their activities of daily living. So when I'm on the road, my ADLs are the same or if I'm at home. Things like getting out of bed, transferring, taking a shower, bathing, putting my suit on, dressing, having a little breakfast, eating. If I needed help with those types of activities, that's what long-term care is, also called custodial care. Now, in addition, someone might be able to accomplish these tasks, but they have to be either supervised or reminded because of a cognitive issue. Something like Alzheimer's or dementia, that's also long-term care. Where does long-term care take place? I've been with the federal program for just about 15 years now, and I started as an inbound phone rep, answering question after question about long-term care, and folks would call me up and they'd say, can you send me your information on your nursing home insurance? And I could certainly help them. I knew what they meant. We might associate long-term care with facilities like nursing home and assisted living. The fact of the matter is, in this country, the vast majority of long-term care takes place in the home. And most of the time, about 80%, that care is provided by unpaid caregivers. Who's that? Generally, it's family members. I like to share a quick story that I have about long-term care, and that's what my family went through with a long-term care situation. And that's what the situation went through with my grandfather. My grandfather was a World War II veteran, greatest generation, proud Vermonter. He went to Europe to fight the war. He came back to Vermont. I don't think he ever left again. But later in life, my grandfather developed dementia. So my grandmother decided she was going to handle this problem the way she handled every other problem in the 50 years before. She's going to take care of him. She's going to take care of him in-house, and she wasn't going to ask for any help. They'd gone through a world war. They'd gone through a flood. They'd gone through 50-some-odd years of marriage. She could handle this. Well, about 6 months into this process of my grandmother being my grandfather's full-time caregiver, my grandmother got sick. Did not get a specific diagnosis. She got old age. She became frail. And the reason was because of the stress of providing care for her husband. And the reason I share my family story with long-term care is that a lot of these presentations deal only with the financial aspects, which we're certainly going to talk about as well. But if you haven't been through a situation with long-term care, you just might not be aware. And there's also a physical and an emotional toll, and not just for the folks who need the care, their family and their support system as well. Why are people planning for long-term care? Simple answer is people are living longer. And the longer that you live, there's a higher chance that you might need some sort of long-term care. They estimate around 70% of folks that reach the age of 65 will need this style of care in their lifetime. And not only is long-term care expensive, which we're going to look at in a couple slides, but because it's non-skilled custodial care, it's not care that's going to be covered by a lot of your other insurance benefits. In fact, the question we probably get most often is in regards to health insurance. I have this great FEHB health insurance. I have a great insurance through my uniformed services background or through my spouse. Why do I need to worry about long-term care planning? And it's probably a separate discussion for us to have. on whether or not health insurance should pay for long-term care. The fact of the matter is, in today's world, it does not. And it doesn't matter what health insurance you're talking about. If you have that FEHB program, if you have TRICARE or TRICARE for life from a uniformed services background, or if you're 65 and have Medicare, these are all health insurance. It's designed to help cover what they call the cost of skilled care. You go to the hospital, you go to the doctor, you go to the pharmacy. Health insurance does a great job of covering that. What it doesn't cover, again, is those costs of custodial care. They may have a short-term rehabilitative benefit attached to them, but the key words here are short-term and rehab. So Medicare will pay up to 100 days with a copay. Most claims do not last that long. The average is somewhere in the mid-20 days of a Medicare rehabilitative claim. Other key word here is rehab. Once you're no longer going to get better from your condition, your health insurance says that is no longer our issue. So when my grandfather had to be in a facility towards the end of his life, he wasn't going to be rehabbing his dementia away. Therefore, his health insurance, whether private, whether Medicare, didn't cover any of those costs. Now, there are a couple benefits that do cover these costs of custodial care. But I think it's important to note that not everyone will qualify. And specifically, federal employees who were, generally the folks that I work with, because I only work with the federal long-term care insurance program. The first benefit we talk about is Medicaid, not to be confused with Medicare. Medicaid is the state and federal plan. It's really designed to help folks that live on or below the poverty line. It varies a little bit state to state, but in general, we're talking about assets of around $2,000 or less to qualify. Typically, it covers care in a nursing home. They are working to build more community-based care into Medicaid, but in general, when you're talking about Medicaid, you're talking about nursing homes. You're talking about nursing homes that accept Medicaid patients. And if you have more than that $2,000 limit, Medicaid says that's great. Come see us when you have $2,000 or less. So folks need to spend down their assets first to qualify. Now, while most people, when they think about Medicaid, they think about assets because most folks, once they retire, will no longer have the same kind of income stream. But one of the really great things about retiring from federal service is that you're going to receive your pension, your annuity, for the rest of your life. So regardless of what your assets are, the fact of the matter is you're probably going to be making too much money in retirement based strictly on your income to ever think about qualifying for Medicaid. It's an important benefit for a lot of folks. But the good news, bad news is you're probably not going to qualify because the good news is you're making too much money in retirement. VA. VA is another federal benefit that does cover some custodial care costs, obviously for veterans, but not all veterans. Only veterans that have a high service-connected disability. The number that I hear most often from the VA is at least 70%. They're also going to look at your ability to help cover those costs yourself. And they're going to look at available funding, meaning is there a bed available in my area? So while a veteran might still go to VA facilities for their hearing aids or eyeglasses or health checkups, the idea of retiring to the old soldiers' home on the hill doesn't really exist in today's VA. VA also offers an aid and attendance benefit to wartime veterans and their spouses who can receive care in their own home. But that is also income and asset level based. So I like to share the information so that you have it. But for most folks that I work with within federal service, their income and assets are probably too high. Long-term care is expensive. These numbers are from the 2018 John Hancock Cost of Care Survey. Metro DC, $111,000 a year. Places like Orlando, Florida, and Phoenix, Arizona, higher population of elderly, little less expensive, but still $98,000 in Orlando, $83,000 in Phoenix, San Francisco or Northern California, to no one's surprise, at $120,000 a year. But even someplace like North Dakota, there's just not a lot of facilities in the Dakotas. Therefore, it's one of the more expensive places in the country to receive care. So when you look at these numbers, the questions that most folks will ask you is, can your retirement handle these costs? But I think the more important question to ask yourself is, is that what I want my retirement to do for me? You've all worked really hard. So upon retirement, you can live a certain lifestyle. Spouse can live a certain lifestyle. I made promises to kids or grandkids about weddings or educations. Can I fulfill those promises if I'm paying these out-of-pocket expenses? And that's where long-term care insurance fits in. It's an insurance. So you're paying a premium now so that down the road, if you have this need for care, insurance is going to help cover and defray those costs. And the most important thing about long-term care planning, in my opinion, is that long-term care insurance, it's not nursing home insurance. Certainly, it's going to allow you to receive care in facilities, but it's going to allow you to stay at home as long as possible, what they call age in place. If my grandfather had a long-term care policy, my grandmother could have still been there to oversee his care, but she wouldn't have had to been the one to provide the care, especially the difficult and stressful care. Well, that's the first part of the presentation, just discussing, what long-term care is. I think the biggest takeaways are that, it is different than what we think of as traditional healthcare. So if you decide that long-term care insurance is an insurance that you have interest in, it's not there to replace your health insurance because it covers a different style of care. Other takeaway is that you don't really have any other federal benefits that are going to help cover or defray these costs. Now we're going to start talking about long-term care insurance. Again, specifically the federal program, the FLTCIP. And I can be fairly honest with you that if you are looking at long-term care insurance today, most of the plans are going to work, about the same. There's not a huge variation in what's being sold policy to policy. So really what it's going to come down to when you're making your decision is a few of the ancillary benefits and, of course, price point. And we're going to touch on all of these benefits and pricing for long-term care now. The biggest change that I've seen in my 15 years with long-term care is this idea of comprehensive coverage. Comprehensive coverage simply means that you can choose where you need the care at the time that care is needed. So you don't have to decide when you purchase your policy the types of locations that will be accepted. So when I started, again, 15 years ago, you could buy a facility-only plan or a home care-only plan. But most of us don't know what our level of care is going to be or needs will be in 40 or 50 years when I might need this policy. So now the federal plan offers this comprehensive program. So that means you can receive care wherever it makes sense. Certainly assisted living, certainly nursing home, certainly hospice facilities, but more importantly, community-based care, like receiving care in your own home or receiving it in adult daycare centers. The biggest difference, though, with the federal plan is this idea of how we offer our home care. A lot of plans are going to offer home and facility care. But what we offer is what we call informal caregiving for home care. So what the difference is, and we certainly offer formal caregiving as well. Formal caregiving is what most long-term care policies will offer you. You pick up the telephone, you call a home health agency, they send a licensed professional to your home. Great, we certainly offer that as well. What we also offer is informal caregiving. That means that you can choose your own care provider and they don't have to be a licensed professional. It can be a neighbor, a friend, a relative, a member of my church. Oftentimes folks that might be there to help support us anyways, now they can get a financial benefit for doing so. So my niece is going to provide care for me, but she has to miss a couple hours of work in the morning and a couple hours in the afternoon. I can pay her for those missed work hours as my paid caregiver. There's really only two stipulations for informal caregiving. And the first is family members are capped at 500 days. So a total of 500 days, your family members can be the ones that provide care. If it's a member of your church or a neighbor or a friend, there's no cap, just on the family members. The other stipulation is that whoever's going to be your care provider would not normally be living with you at the time your care needs start. So if you kind of read between the lines there, what that's really saying is that a spouse can't get a financial benefit for providing care for a spouse. But again, take it from my grandparents, that's kind of why you have long-term care insurance. Your spouse doesn't have to be in that position. But just for argument's sake, let's say my niece is providing care and she calls me up 6 months into this process of being my care provider, says, you know what, my lease is up, your house is 20 minutes closer to work than mine. What if I move into that third bedroom? I'd be okay. I could continue to pay her, but she wasn't there when my care needs started. So again, informal caregiving gives you a lot more flexibility on how you can spend your benefits. It's an important difference between the federal plan and private plans. So you will design your long-term care insurance coverage. You make a couple decisions by choosing a daily benefit amount, a benefit period, and how you protect those two things from inflation. And again, if you're shopping in the private market for long-term care, these are the same three decisions you will make. This is how you build traditional standalone long-term care insurance. The first thing you want to think about is your daily benefit amount. How much per day do you want the insurance company to pay for your cost of care? We go from $100 to $450 in $50 increments, and you can use up to 100% of your daily benefit regardless of where you're receiving care. So 100% of your DBA can be used at home, 100% can be used in a facility, or 100% can be used even internationally. We'll focus a little bit more on international coverage in a few slides. So when you are thinking about the daily benefit amount, probably the most important thing to think about is, well, where do you think you might use the policy? My slide says consider the cost where you live. But again, a little bit better way to say that is consider the cost where you think you might be using your benefits. That means where do you think you're going to retire? You know, a lot of federal family members have moved throughout the country because of the nature of their work. But that doesn't necessarily mean that's where they're going to stay upon retirement. So think about where you might retire. Again, the plan works exactly the same across the country, but what does vary is that cost of care. I did a presentation for a federal executive board in Kansas City, and I told that group, I said, if you tell me you're planning on retiring in Manhattan, Kansas, you might choose a different daily benefit than someone who's going to retire in Manhattan, New York. How come? Well, the cost of care is probably significantly different. So on our website, ltcfeds.com, we do have a cost of care tool. Just put in your state, nearest large metropolitan area. It'll tell you what the rates are for home care, assisted living, and nursing home. So you can make an educated choice on what type of insurance to purchase. Next decision you make is your benefit period. We offer three options: 2 years, 3 years, and 5 years. I'm actually going to skip ahead one slide and talk about how the benefit period works before we talk about why someone might choose 2, 3, or 5. Because this is probably the most confusing part of purchasing long-term care insurance, this idea of benefit periods. And I think part of the reason it's confusing is I don't love the name, to be honest. I think it's the same name that every insurance company uses for benefit periods. It's not just us. But I think there's some confusion because of the terminology of benefit period. So in this example, I've chosen a $150 daily benefit and a 3-year benefit period. So if I were to think, well, I have a 3-year benefit period, that must mean I'm only covered for 3 years. But really what it should be called is your benefit multiplier. So I take my 150, I multiply it by 365 days in a year, then by 3, or 1,095 days. It gives me a pool of money, $164,000. I'm going to receive my benefits until I fully exhaust this pool. So if my niece is providing care for me, charging me $75 a day, well, the other $75 can be used at a later date, meaning that my 3-year benefit period could last 4, 4.5, 5, 6, 7 years. What's important is how I draw down the pool, not a specific time frame. So again, we offer a couple different options: 2 years, 3 years, and 5 years. Industry-wide, 3 years is the most popular option for benefit periods. I have a couple theories on why I think that is, and probably the biggest one is that, well, someone either went online or they sat down with their insurance professional and they found this statistic about long-term care, and that is the average stay in a nursing home in this country, about 2.4 years. People look at that and they say, well, I guess I need to get a 3-year benefit. And I get it. I understand why folks make that connection. But if this was a live seminar and we had 30 or 40 or 50 people in the class, someone would raise their hand and they'd say, that's great. However, my mom was at a facility for 10 years, or my dad was in a facility for 6 months, or my grandmother was in a facility for 15 years. So when you were thinking about benefit periods and daily benefits and how those two work to give you a maximum lifetime benefit, probably more important than a nationwide average is what's your family history. Did you have 4 grandparents that lived to 102 and never needed a day of care? Maybe that's someone who's choosing a smaller long-term care policy and someone who unfortunately has a strong family history of something like Alzheimer's or dementia or MS or Parkinson's, things that might put someone in a facility for a longer period. So 2 years, 3 years, or 5 years are your choices. Remember, they are not time periods. They are multipliers to multiply your daily benefit. Again, it's probably the most confusing part about long-term care. So I'll give you some resources at the end. So if you have any questions, we have a great team that can help answer them. Last decision you make is inflation protection. So you've chosen a long-term care policy by choosing your daily benefit, choosing your benefit period gives you a pool of money. You want to make sure that pool of money is going to make sense in 30 or 40 years when you might need to start draw down on it. So we offer 2 different options, automatic compound inflation option or a future purchase option. How the automatic option works is every year on the anniversary of your purchase, your daily benefit is going to increase at 3% compounding. So my 150 is going to be worth 3% more next year, so on and so forth. There is no corresponding increase to your premium with this 3% growth. But what you're effectively doing is pre-buying your inflation protection by choosing the automatic option. The other option is what we call the future purchase option. This one works a little different. How the future purchase option works is every 2 years on the anniversary of your purchase, you're going to receive a letter. And that letter will say, well, the actual rate of inflation for the past 2 years has been X%. Would you like to purchase an additional amount of insurance to keep up with that? If you say yes, well, the key word here is purchase. You're buying more insurance, so you're getting an increase in your benefits and an increase in your premium. Your original amount of coverage stays the same rate, but you're buying additional blocks as you go with the future purchase option. You don't have to take the increases. We guarantee you the right to purchase them, but you can say no. If you say no 3 times and you want to, we will stop sending you the increases. You can always request to have them resent. You just have to show proof of good health. And I do like to show some examples of premiums because I think it really helps folks understand the difference in the 2 inflation projections. So the first column is that 150 3-year benefit period, 164 maximum lifetime benefit used in the early examples. I'm showing rates for 40, 50, 60, and 70. There is a different rate for every age. So 41 is different than 42, different than 43, so on and so forth. But it gives you an idea. You can see that the future purchase option is much less expensive than the automatic. How come? Future purchase option doesn't have that built-in growth of 3% like the automatic option has. On the website, ltcfeds.com, we have a great premium calculator. So you can go in, you don't have to put your agency, you don't even have to put your name. You just need to put your date of birth or your age so the system knows how old you are. And you can calculate all the premiums based on your age and the 3 different options of daily benefit, benefit period, and inflation protection. And the rates that you see would be the actual rates that you would pay, assuming approval into the program and assuming you apply before your next birthday. So it's pretty transparent what the costs are going to be. You don't need to talk to an agent to find out what long-term care insurance will cost you. You can do it right on the website. Every plan has a waiting period. Some private market plans may call this an elimination period, 90 calendar days. So how you become eligible for your benefits is that your healthcare professional certifies that you need assistance with at least 2 of the 6 activities of daily living: eating, dressing, bathing, transferring, toileting, or continence, or I need supervision because of a cognitive issue. That's what starts my clock. It does not matter if you have any out-of-pocket expenses during that time, but you need to be aware that if that happens, then that will be your responsibility. The insurance company will not pay for long-term care claims within the first 90 days. You only have to satisfy it once in your lifetime. So if I have a stroke, I need care for 6 months. I get better. 5 years down the road, I need care again. I've already exhausted my waiting period. Therefore, I'd be able to receive benefits day 1 of being eligible. We don't pay traditional long-term care benefits during this time unless someone is taking advantage of hospice or respite service or our stay-at-home benefit. Stay-at-home benefit is a separate pool of money included in every policy, no additional cost. And it's really what it says. It's designed to help folks age in place and stay at home. So it's 30 times your daily benefit. It does not reduce the maximum lifetime benefit. And you can use it for things like durable medical equipment. I could stay at home, but I need a hospital bed. Insurance company would pay for that. Home modifications. I could stay at home, but we need a wheelchair ramp or grab bars in the shower. Insurance company would pay for that. Home safety checks. You know, mom and dad have lived in that house for 50 years. Is it still safe for them? Can we get the mom and dad to one floor living? Can someone come in and remove tripping hazards or area rugs? Insurance company would pay for that. Emergency medical response systems. I think we all remember that poor woman who'd fallen and couldn't get up. You know, if I had one of those, could I stay home? Again, insurance company will pay for that. Caregiver training. So we allow informal caregiving. My niece is going to provide care. She's never done it before. Does she know how to safely help me move from a bed to a chair, safely step in and out of the shower? She can get training on that. Again, because in my opinion, most important part of your long-term care planning, the idea of aging in place and be able to stay at home, as long as that really makes sense. Care coordination. Care coordination is the group of registered nurses that will work with you and your family once you have a need for care. Really what their probably most important task is they help design that plan of care with you. So they can help find providers. They can help find discounted providers. They can help with long distance caregiving. I live in Maine, mom lives in Florida, mom has long-term care insurance, needs care. Well, I don't know what the good facilities or the good home health agencies are in Florida. I can use care coordination to help assist with that. We don't have any kind of in or out of network services. It's really up to you where you receive your care and by whom. But obviously, if you can have an advocate that's working for you, it's going to make the process a lot easier for you and your family. International coverage, we touched on this briefly. You can use the policy anywhere in the world, and you can use up to 100% of your benefits anywhere. We used to have an 80% cap on international coverage. That is no longer the case. Anything that's covered in the States would be covered overseas. There's also no war exclusion with a federal plan. A war exclusion means that some private plans, if the reason that you need care is because you were either injured in an act of war, whether that's declared or undeclared, or you're injured because of your history with the uniformed services, they may not have to pay those claims. That is not the case with a federal plan. There's no war exclusions. Regardless of why you need the care, the federal plan is going to be there for you. Premium stabilization feature. This is the newest addition to the federal plan. This is the FLTCIP 3.0. That's the current program offering. This was rolled out October in 19. And really what the PSF is it's a way to help us mitigate the need for future rate increases. We'll certainly talk about rate increases on the next slide as well. But what it is it's a percentage of premiums that you've paid in that is adjustable based on the health of the program. So that percentage will be higher if the program is doing well. If the program is not doing as well, that percentage will be lower. It fluctuates. So it acts as a shock absorber to help allow us not have to hopefully reduce your benefits or increase premiums. What you can use this PSF for is two things. One is to offset future premium payments. Once I reach a certain age, become vested in the program, and I can use my PSF pool to pay down my premiums, so my premiums don't cost as much that month. But the other thing that you can use your PSF for is for a refund at time of death if you never use your benefits. Because I probably got that question at least once a seminar, if not once every other seminar. What happens if I never use my benefits? And my response was usually something to the effect of, well, that means you didn't have a long-term care issue. That's kind of a good thing. I have homeowners insurance, but not because I'm looking forward to the tree coming through the living room. I have it so I'm financially protected. Now, my much less snarky response to that question is, well, if you never use your benefits, and whatever you have in your PSF percentage can be left to a beneficiary as a death benefit. On the website, there's a great instructional video that walks you through how the PSF works, how you might see it raise or decrease, and how you can use it, again, for either a death benefit or a reduction of premiums. When we talk about premiums, it's important to note that FLTCIP coverage is guaranteed renewable. That means that once you purchase your policy, as long as you're paying your premiums, it's your policy. You can't take it away from you. It doesn't get more expensive because you're getting older or less healthy. However, premiums are not guaranteed. There's always a chance that you're part of a group that the actuaries say, uh-oh, we're concerned, that in 20 or 30 years, there might not be enough money in the pool to pay full claims. We have to institute some sort of group rate increase. We've been around since 2002. Over that time, there's been 2 rate increases. It's important to note, again, that PSF is designed to help mitigate that need going forward, but it's not something we can guarantee. It's not a federal long-term care insurance issue. It's a long-term care insurance issue. Every long-term care policy has had rate increases. The protection you have with the federal plan is that we cannot raise rates without the approval of OPM. We are part of your federal suite of benefits. The FLTCIP is the largest group long-term care policy in the country. John Hancock is the current underwriter. Again, we're the only plan that's sponsored and overseen by OPM. Now, that means a couple things to you. And I think, most importantly, it means that we're a federal benefit. You can do a payroll deduction. But the other thing it means is that we're, John Hancock, to no one's surprises, a for-profit company. But that profit is pre-negotiated with OPM. And it's based on us hitting certain performance metrics. So literally, John Hancock makes money on the federal plan if they do a good job running the program. And we can only use premiums for the cost of running the program and paying federal long-term care claims. So if the insurance provider has any issues with its other books of business, can't dip into this fund. It's a completely separate pool. So again, reading between the lines a little bit, because it's a pool that can only be used for paying federal claims, there's no financial incentive for the insurance company to deny claims. Our claims approval rating is higher than 95%. So folks want to know down the road when I need care, if I need to use this policy, is it going to be there for me? Yes, it's a federal benefit. Am I going to have to jump through hoops to get my claims paid? No, because we can't use that money for anything else. In fact, one of our performance metrics is how quickly we actually pay the claims. So some additional details on the federal long-term care insurance program. Some of these we've touched on briefly. Premiums are based on your age at time of application. So when we do events outside, whether it's during open season or during a wellness event in the spring, and we're inside federal agencies, people come to my table, they typically have 2 questions. How much does it cost and when should I apply? And I say, well, rates are based on your age at time of application. So the younger you are, less expensive the premiums. But it's also important to note that long-term care insurance is still a medically underwritten program. So you do need to be in relatively good health at time of application. When I was on the phones, I would get that call once a day. I just got back from the doctor. I just got back from my wife's doctor. I just got back from my mom's doctor. I have this condition. My wife has this condition. My mom has this condition. Boy, we really need to sign up for long-term care insurance. I say, I'm sorry, sir, but because of XYZ diagnosis, unfortunately, you are not eligible for long-term care. So when people ask me what's the best time to apply, my answer is always when you're in good health. We know what our level of health is today. Unfortunately, we don't know what it's going to be tomorrow. But we are not medically rated, meaning that anyone who's 55 years old that gets XYZ coverage is the exact same as any other 55-year-old. You don't pay more if you're less healthy. You don't pay less if you're more healthy. It's pass fail. As long as you meet that minimum threshold, you pay the same rate as everyone else. Everyone applies individually. We'll look at qualified relatives on the next slide, but everyone has their own policy. I'm not buying a self plus one or a self and family with long-term care insurance. The coverage is fully portable. If you leave federal service for any reason, you take the insurance with you. And your qualified relatives, which we'll see on the next slide, they can apply even if you don't. So who's eligible? Employees of federal and postal service employees, but also postal service and federal annuitants. So unlike your FEHB, you do not need to carry this for 5 years before retirement. You can apply as a retiree or as an employee, and it doesn't matter. Rates are only based on your age and amount of coverage that you choose. Active and retired members of the uniformed services, and then their qualified relatives. spouses, domestic partners, adult children, also parents, in-laws, and step-parents of employees in active duty uniformed services. Now, I always like to point out that parents, in-laws, and step-parents, because that's one that folks are a little surprised about. They're not aware. They say, well, does my mom have to be my dependent? Nope. Just because they're your parents or your in-laws or your step-parents, and because you're a federal employee, those folks are eligible to purchase long-term care. They would have their own policy. Their rates would be based on their age, not yours, but they are eligible. So if I do a new hire briefing, and it's 25-year-olds staring back at me, they don't see the value of long-term care insurance at 25 years old. And it may or may not be the best use of their insurance dollars either. But I can say if mom and dad are looking for long-term care, they're eligible because of your federal affiliation and their relationship to you, regardless if you decide to apply for coverage. So again, no linkage required. Here's some additional resources. Of course, it's 2021, so everything's on the website, ltcfeds.com. We talked about the cost of care tool. We talked about the premium calculator. There's great tools to walk you through the whole design process of building your policy, as well as answering questions. And we have a great suite of webinars. They get refreshed in the spring and the fall. Please utilize those resources. If you have a question about long-term care, the best way to get it answered is to call the toll-free number, 1-800-LTC-FEDS, 1-800-582-3337, where they're 8 to 6 Eastern time. Like myself, none of these folks work on commission. They are just there to educate about long-term care planning, and long-term care insurance. So they will not be calling you at supper time to ask you why I haven't signed up yet. And when you call into them, their goal is not to sell you a policy. It's to educate you about long-term care and help you guide you through the process. There's nothing wrong with being a commission salesperson, but commission comes from somewhere. It comes from making sure that you buy the most expensive policy you can. If that's not the right fit for you, we can tell you that. We can walk you through what the needs are going to be for your area, your part of the country. We don't want to see anyone over-insure themselves. I do like to share 2 facts about our toll-free number, because I think oftentimes folks these days are a little hesitant to call toll-free. And I don't blame you. I had to call the cable company last week, so I get it. But 2 facts that I share about our toll-free number. Part of our contract with OPM, that we answer at least 85% of our calls within 20 seconds. Probably even more important is that once you call the toll-free number, it's one button. Option number 1, within 20 seconds, you have to a real live person in the beautiful seacoast town of Portsmouth, New Hampshire. I'm a little biased because it's how I got my start. I managed that group for a little while before I started working directly with the agencies and affinities. But if you have a question about long-term care, it's the best way to get an answer. So I will leave you with a couple quick thoughts on long-term care. Thank you very much for your time today. Long-term care insurance is not for everyone. The federal long-term care insurance program is not for everyone. But the idea of having a plan for your long-term care needs, whether that's insurance-based or not, is absolutely for everyone. Because I've been doing this for a long time, and people would really like to believe that this type of situation is going to bring your family closer together. I can tell you that's not always the case. You know why? You're doing more than somebody else. So when I called my brother, I said, I think we need to get help for mom. She fell last week. I came in today and the stove was on with nothing in it. He says, well, I saw her a couple months ago. She seemed fine. Well, I live across the street from mom. I see the struggle she goes through every day. Mom needs to be in a facility. She gets that bill, $140,000 a year. She can't afford it. So she calls me up and I call up my brother. Maybe we haven't made the same financial decisions. How's that going to affect our relationship going forward? How does it change that relationship with my mom? How does it change the relationship with my brother? I get it. These are not easy conversations to have. We as a society do not do a great job of talking about end-of-life issues. But I can guarantee you with just about 100% certainty, it's a lot easier to have this conversation when everyone's well than when someone's sick. Medical power of attorneys. If mom's sick, is there someone that can speak on her behalf? If you're sick, is there someone that can speak on your behalf? HIPAA has done a great job of allowing us to move from doctor to doctor and move our medical records. But if mom lives in Florida and I call up her doctor, we don't have that power of attorney. They can't talk to her. Not because they don't want to. Legally, they can't. And what a challenging conversation to have with mom. Mom doesn't think she needs to worry about this yet. There's no health conditions. I'm fine. It's a conversation you don't want to be having in front of a judge. So if you're, looking to purchase long-term care insurance, I think the federal plan is a great plan. I think the benefits of the informal caregiving and the fact that it's a federal benefit really, push it to the top of long-term care policies. But the most important takeaway from my sessions, hopefully, less about purchasing insurance, just making sure that you have a plan for you and your family should you have these long-term care issues in the future. So again, thank you very much for your time today. And if you have any questions, please don't hesitate to reach out either at the toll-free number, the website, and we also have our email address up there as well. So thank you very much and enjoy the rest of your day.